Hello and welcome to today's presentation about taxation and compliance issues faced by NRIs. So first of all, a standard disclaimer that this presentation is for information purposes only and does not represent any financial, legal or other advice. If you want to take any decision based on this information, then it is best to consult a chartered accountant or a professional. Now, this is briefly about me. I am a chartered accountant by profession. I work in the NRI taxation, cross-border investments, FEMA compliance, and income tax advisory domain. My working experience has been around 18 years overall, and in this I've done a lot of consulting assignments for all these fields. I've been NRI myself. I've worked and studied in UK. I've done my master's there from Leeds Met University, and then I know the first-hand problems that NRIs face for investments and their taxation issues. I have also worked with Big Four consulting firm PwC and law firm ELP from Mumbai. So in this presentation, we will cover the residential status as per FEMA and income tax, the different type of bank accounts that NRIs can hold, the various income tax aspects for NRIs, then the investment options available in India, and then we will also take the FAQs and then followed by the queries from the participants. First of all, now the different parameters on which Indian markets are booming as compared to other markets. You can clearly see the comparison here. Then this is an interesting research by the Mint for the emerging markets. So this basically shows you how India is performing as compared to other emerging markets in the world. And India has been consistently ranked as #1 for many months now. How can you as an NRI participate in this growth story? So we'll take it one by one. First of all, can NRIs invest in India? So there are three types of people who are resident outside India. First is an NRI who has an Indian passport, but who is not a resident in India. He can invest. Second is somebody who has surrendered his Indian passport and taken a foreign passport, but has a OCI card. He also can invest in India. And then PIO, which is a person of Indian origin, who's basically a foreign citizen, but who has Indian roots. Forefathers and all were Indians. So even they can invest in India. Now the residential status. Residential status in India is defined by two acts. Now, generally, what we need to understand is that FEMA is a more stricter regulatory law, and income tax is a revenue law. Meaning, income tax is concerned about the calculations and how much tax you should pay, how should you disclose your income, and all those things. Whereas FEMA is more concerned about the regulations, like what all activities as a NRI can you do, what transactions can you enter into, and all those regulatory requirements concerning NRIs. Now the residential status as per income tax depends on the number of days you stayed in India in the previous year. So it is always on a historical basis, like during last year, what was your residential status? Whereas in FEMA, residential status depends on the purpose of stay outside India. So what is your purpose of leaving India? That is very important to determine your residential status as per FEMA. Residential status, as I said, it's checked every year at the time of filing income tax return for the previous year. So at the next year, when you want to calculate your taxes for the past year, which is called as the previous year in Income Tax Act. So previous year, when you want to check what was your residential status, what was your taxation liability and all those things, that time you check the residential status in Income Tax Act. Whereas as per FEMA, residential status has to be checked as on the date of doing every financial transaction. So are you a NRI, I mean a person resident in India or a non-resident? That needs to be checked every time you're entering into any Forex transaction. So the purpose of this is, purpose of determining your residential status is, it helps in determining your taxability of income as per income tax. Whereas as per FEMA, it governs all your financial transactions like mutual fund shares, bank accounts, what assets can you purchase and everything. Now, as per FEMA, we will dwell deep into it. Like, as I said, your purpose of going outside India matters to determine your residential status. So there are three major examples which are taken. If you're employed outside India or living for an uncertain period, then you become a non-resident the moment you leave India. Similarly, if you are going for starting a business outside India, like if you're a director of a company or if you're a partner in a firm and you leave India to manage that firm, then you become a non-resident the moment you leave India. Third is when a student gets enrolled in any overseas university and leaves India, then as per RBI Circular 45 mentioned here, you become a non-resident the moment you leave India. Otherwise, in any other case, if you are not FEMA and income tax both define the residential status as a resident Indian, and whoever is not an resident Indian is a non-resident. So is always an exclusive definition. So even here, residential status as per FEMA is defined as if you have stayed in India for a period of 183 days or more during a financial year, then you are considered to be a resident Indian, and if you are not, then you are a non-resident Indian. Now, what happens once you become a non-resident? So, what are your obligations? First is you don't need any permission from RBI or income tax authorities. Second is you are not allowed to maintain a resident saving account. You need to convert it to NRO account by completing your KYC with the banks. Third is you have to convert all your resident demat accounts to non-resident demat accounts. And the fourth thing is, while filing income tax return for subsequent period, you have to report your residential status properly as per the Income Tax Act. So, Income Tax Act residential status may differ from that of FEMA, because even if you leave on 30th of March, you become a non-resident as of that date, as per FEMA. But as per income tax, since you stayed for more than 182 days in India, you become still a resident for that year. So you have to determine your residential status properly as per income tax, as per their calculations. Now, what does Income Tax Act say? Income Tax Act says that if you are a person resident in India for 182 days or more in the previous year is the last financial year. If you were in India for 182 days or more, or 60 days or more, plus more than 365 days in the four preceding financial years. So, if any of the criteria is met, then you become a resident Indian as per Income Tax Act. So now, as per for the tax planning purposes, we have taken some examples. Like, when should an Indian citizen leaving for their first overseas job depart to optimize tax strategies? Now, what happens when you become a resident Indian is that you have to report all your global income and you have to offer it for tax in India. So even if you leave outside India for job, you may be getting salary in foreign exchange. The tax is also paid there itself from your salary. But still, you have to offer it for tax in India as well. Of course, you can claim DTA benefit, but then you have to report that income and offer it for tax in India. So to avoid that, what is the best time to leave India? If you are never moved outside India, like if you're a fresh graduate, if you want to start a new employment outside India, then the best time to move is on or before 28th of September. So that will ensure that you are a non-resident from that year itself, and then you escape that hassle of reporting taxes in both the countries, offering it for tax and everything. Similarly, the other case, like if you have been living outside India for a long time, you want to permanently return to India, then what is the best time to come back to India? So the best time would be you can come on or after 2nd February if you have been staying in India for more than 365 days in the last four financial years. So if you have been on and off coming to India, trying to settle down in India, if your period of stay is more than 365 days in the last 4 years cumulatively, then the best time to move in would be 2nd February or after that. And if you have not been coming to India for more than 365 days in the last 4 financial years, then you can move on or after 3rd October. This will ensure that you are a non-resident in that particular year. So at least you get a breathing space, a time to settle your finances when you relocate to India. Coming to the banking aspects, there are three major type of accounts which can be held by NRIs. First is an NRO account, second is NRE account, and third is the FCNR account. So NRO account is basically, when you do your KYC as a NRI, when you're first time going outside India, when you do your KYC that now I'm a NRI, then your saving account get converted to NRO accounts. If you don't have any saving account, then NRO account can be opened only by way of inward foreign remittance. Second is the NRE account. NRE account is basically a rupee denominated but repatriable account. So first NRO was a non-repatriable account. It is majorly used for your Indian income or the income that you had before moving outside India. NRE is something which is a rupee dominated account, but it is repatriable. So it can be anytime converted to foreign exchange and the money can be taken outside India. So this can be opened only by an NRI. So only after you become an NRI, this account can come into existence. The first account was earlier a saving account, so the same account can be maintained even if when you become a non-resident. But that is not the case in NRE. NRE account can only be opened when you have a status as a NRI. Now credits must be from forex converted to INR sent from overseas or Indian repatriable income. So only in these two cases, credits can be given to the NRE account. Third type of account is the FCNR account. FCNR account is basically a foreign currency denominated repatriable account. So this is basically a fixed deposit and not a saving account. So, and the interest that you earn on these fixed deposits are not taxable in India. And this is denominated in foreign exchange. Now, this is a difference between NRE, NRO, and FCNR accounts. I'll only cover the major aspects. First is that, this is Indian rupee denominated NRE account, NRO account, both. Whereas FCNR is a foreign currency denominated account. It can be in any convertible currency. Major currencies, all banks accept, like USD, GBP, Australian dollar, Singapore dollar, Canadian dollars, Swiss francs, euros, and Japanese yen. The deposits can come in NRE account only through foreign currency. In NRO account, it can be your Indian income also, so rental income in India or any other fixed deposit income or everything. So that can be credited. And the third is FCNR, which is again, foreign currency only can be deposited. Withdrawals can be, NRE and NRO both are rupee denominated accounts. So withdrawals will obviously be in Indian rupees only. Whereas FCNR is a foreign currency denominated. So when you withdraw, again, you will get the foreign currency only, whichever you had initially deposited. Nomination in all three accounts is permitted. Now, for the fixed deposits in NRE accounts as well as the FCNR accounts, the interest is not taxable in India. In case of NRO accounts, your fixed deposit interest or the saving interest, everything is taxed at 30% plus cess. Now, if you want to open a fixed deposit account in NRE, then the minimum tenure is 1 year and maximum is 3 years. In NRO, it's just like a resident saving account. And in FCNR, again, minimum is 1 year and maximum is 5 years. Now, as I said, the interest. Now, coming to the interest part, interest is always freely repatriable. So, whatever interest you get on these deposits can be repatriated outside India without any limit. Now, the repatriability of the principal invested. So, NRE, of course, you had invested through foreign currency only. So, it is freely repatriable. FCNR, again, it's freely repatriable. NRO accounts, you can avail the USD 1 million limit, which is available on a yearly basis. Can you hold a joint account with NRI? In case of NRE account, yes. NRO account, yes. And FCNR account, yes. So all three accounts permit you to have a joint account with NRIs. Whereas, in case of Indian resident, you can have the NRE account only with a relative. NRO account you can have with anybody. It can be a joint account with anybody. And FCNR account is again only permitted with your relatives. Now, this question is very critical. If you are an NRI holding saving account in India, do you need to close this account or get an NRI account? So if your residential status has changed to NRI, then having your saving account converted to NRO account within a reasonable time is mandated by the law. Now, what is reasonable is not defined as per the act, but it is constituted to be, whenever it's best possible to do it as early as possible. And then, there are severe penalties like 5,000 rupees per day or up to your deposits. So there are different penalties if you don't convert your saving account to NRO account. This is the USD 1 million per year remittance scheme, which we discussed earlier. So from your NRO account, whatever amount you have got, it can be freely repatriated outside India, subject to certain compliances. So even though that account is a non-repatriable account, still you can convert your INR from NRO account to foreign exchange and repatriate it, subject to the ceiling limit of $1 million per financial year. So whatever is the equivalent of $1 million that you can convert and take it outside India every year, that is allowed. This can also be, from sale of immovable property acquired using funds from India or any other investments made in India. So it's a completely $1 million can be repatriated. Coming to the taxation aspects now, e-filing portal of the income tax department, these are some impressive statistics. As you can see, around 8 crore returns have been filed, verified, processed during the last financial year. Now almost all interactions like income tax return filings, communication from department, their forms, everything is online. Even the scrutiny notices, everything is online. So this is the single dashboard from where you can access everything regarding your income tax. Now there are two important tools for the assessees as well as the department to check transactions. So for every assessee, it is important that you can check your transactions before filing the income tax return, and you can comply that even if you've forgotten certain income, you can check here, and then based on that you can report it in your return. Or if there is any false reporting or anything which is not pertaining to your PAN, you can also raise a request to correct that data in these two particular statements. Now first is the AIS report, which is the annual information statement. Now AIS report shows the entire transactions which you have done during the last financial year, like property purchases, any high value investments in mutual funds or anything else that you have made, any TDS, TCS transactions, saving account interest, how much you have earned, dividends, how much you have got, rent received, purchase or sale of transactions of securities, foreign remittances, interest on fixed deposits, your GST turnover, like if you are a partner in any company, then or if you are having any proprietorship firm, then your turnover will also be reflected here. Then the TIS report is this is taxpayer information statement, which is basically a summary of the entire AIS report, which shows under which head what income has to be disclosed by the assessee. So if there is any disparity between the TIS report, which is the summary, and your income tax return, then obviously system generated notices can be issued. Now coming to the best practices for NRIs for income tax, you need to update your address, your residential status, and contact details on the e-filing portal to show that you are a non-resident. You need to provide an updated email address and mobile number which you can access in case if you get any notifications from the income tax department. You have to keep filing your return of income on a regular basis. Yeah, and this is advisable in case even if you don't have any income in India, still it is advisable to keep filing return just to prove your residential status and to report any exempt income. And this can serve as a proof for your foreign tax returns as well. You need to disclose all your bank accounts, assets held, and income generated in India in your ITR. Now, this is a common question by many NRIs that, I don't have access to my income tax portal. My past CA had it, or I don't remember, when I created the password. So how do I access it? It's very simple. You can just log into your net banking, whatever bank account you have where your KYC is updated. There you will find an option of income tax e-filing. You click on this option, and then this will directly take you to your income tax portal without entering any password. Once you log in, you can go to my profile section, which is on the right hand top side. There you can uh, click on the drop down, and then you can change your profile details, your password and everything. So this is very easy. You don't need any password or OTPs to log into your account. You can directly enter through your net banking account. Now, these are some of the special facilities available to NRIs. Like, they are not required to link their Aadhaar card with PAN card. NRIs are not required to disclose their overseas bank accounts in their tax returns unless they are claiming refund and they do not hold any Indian account. And then this is general for everybody, that the due date for filing ITR is 31st July for every other assessees, and 30th September for audit assessees. Now, this is a very important, update or a hurdle for NRIs investing in India. That their PANs have become inoperative. So, what has happened is that, in case if you have not reported your residential status as NRI to the income tax department, they wouldn't know that you are a NRI who is exempt from linking Aadhaar and PAN. So, what has happened is, by default, they have made certain PANs inoperative who have not linked their Aadhaar with the PAN card. And in case if you have not reported that you are NRI, then obviously they wouldn't know, and by default this has been done. So how do you activate your PAN card? Now, first of all, it is made inoperative does not mean that it is inactive. Your PAN card is still active. You can still do transactions, but certain transactions like claiming refund and all are blocked. So how do you make it active? First of all, how do you check the status? So you log into your account. If you don't have the password, as I said, you can go through your net banking. And if this error on the top is shown that your PAN is made inoperative as it is not linked to your Aadhaar, that means the status is inoperative and you need to take action. Now, what action needs to be taken is you need to contact your JAO, who is your jurisdictional assessing officer. You have to show all the documents like your passport stamps, your overseas stay, whatever document you have got, your driving license or any ID proof overseas. You have to show him that you have been a non-resident for many years, and that is the reason you have not linked your Aadhaar with PAN. So that is why your PAN card should be made active, and they'll promptly do it. Generally, it's a manual process, so it may take time. Like if the officer is on leave or he's busy, has not seen the mail and all, then it may take time. You may need to send some reminders, but then generally they are very proactive and they activate your account as soon as it comes to their notice. Now, this we've discussed earlier as well, like why should you file your income tax returns even if the income falls below the specified threshold? So first benefit is it substantiates that your residential status and income sources, like you are a non-resident, that is the reason you're not reporting any of your foreign income, any foreign assets that you may hold, you're not, required to disclose in your income tax returns, or you're not offering it for tax in India. So if suppose your residential status is not updated for the past many years, but department knows that you were a resident earlier, and if they come to know about certain transactions happening overseas on your behalf, then they may question you, why have you not reported in your income tax return? Now, if you proactively keep filing your returns showing that you are a non-resident Indian, then this question will not arise. So it's a very, advisable thing to keep on filing your returns. It will also facilitate property transactions smoothly. Claiming refunds for TDS deductions, like for every foreign transactions that you do, there is a TDS implication. You can claim the entire refund if you are below the taxable limit. If there are any carry forward losses, that can be taken forward to the next year only if you file your return on time. For your eligibility to take loans and all, this helps to have a proper source of document. Reporting financial transactions and exempt income. So even if you have certain income in India, like a PPF maturity which has happened, which is exempt from tax, but then suddenly a big credit has come to your account, then to prove that it was exempt income, you need to file your return. So even if it's not mandatory, it is always advisable to file your return on time. And then, of course, establishing transparency with tax authorities in India as well as in your home country. This will prove as a valid proof. Now, similarly, if your TDS is getting deducted on rental or interest income, you may argue that, since there is no loss to the exchequer, why should I file my return? So it's not about a loss to the exchequer. There are certain, in the law, it is prescribed when do you need to file return. So if you have got any income above the threshold limit of 2.5 lakh rupees, or if you have any capital gains or other type of income, then you need to file your ITR. So as per section 139(1), you need to file your return on time. Then there are penalties if you don't file on time, and it may also attract scrutiny. And if your email address and the mobile number is not updated, then you may not receive those notices as well, and which can have serious consequences. So it is always better to comply with the law. Keep filing your returns. If there is any TDS, you can claim it back. Now, can NRIs hold Aadhaar card? NRIs are also eligible to hold Aadhaar card. In case if you have Aadhaar card when you were a resident Indian, you can very well keep it. Now, if you want to apply, Indian passport is mandatory. So for proof of identity, Indian passport of NRI is mandatory. So without Indian passport, so in case, if you are a OCI card holder who has surrendered his passport, then you cannot get a new Aadhaar card. But if you had an old Aadhaar card, you can still retain it. Secondly, you can only share an Indian mobile number for OTPs and all. So you need to maintain an Indian mobile number to get OTPs if you want to use that method of verification of your income tax returns or anything else. Now, what is double taxation? Double taxation is basically if you are NRI having income in India as well as in your residence country, then do you need to pay tax on the same income in both countries, or how does it work? So basically, India has signed double tax avoidance agreement with more than 90 countries. What it means that, if you have paid tax in your residence country and if you are reporting that income in India, or if you have generated certain income in India and you're reporting your taxes overseas, then you may get a credit of the tax that is already paid in the other country. So India grants that kind of relief with the 90 countries, and they will also give you that relief. So India has DTAs with 90 countries. You don't need to pay double tax on the same income. Now, these are some of the pitfalls that you need to avoid from income tax or FEMA perspective. First is declaring residential status as resident Indian in ITR and not filing Schedule FA and paying tax on global income. Now, what happens is there are in many cases what NRIs do is they try to declare their residential status as a resident Indian because it's easier to file those returns. And they are not aware of many other provisions, like if you're a resident Indian, then you need to report all your global assets as well as global income and offer it for tax in India. So if you have wrongly disclosed your residential status as a resident Indian, then what will happen? As per Schedule FA, if you have not filed the entire annexures and everything, then there is a minimum penalty of 10 lakh rupees for non-compliance or wrong reporting also. So if you have not filed Schedule FA, you may get a notice, and the penalty is very severe. And again, if you have not offered it for tax, then also there will be a problem. And then after a notice is issued, if you come forward and say that you are a non-resident and still you filed as a resident Indian, then again it was a false declaration from your end. So this can create a lot of hassles, scrutiny and everything. So it's always advisable to consult a chartered accountant to file your income tax returns rather than doing it yourself. Second is transferring funds from NRO or NRE account to saving account of same person. So if suppose you have become a non-resident Indian, you had, for example, you had an account in HDFC and one account in State Bank. So the State Bank account, you kept your saving account status as same because it was a joint account with, let's say, your mother. It's easier for her to go and withdraw the money and everything. So you maintained your saving account in SBI, and whereas you have converted your residential status as a NRI in your HDFC, and by that virtue, the saving account has become a NRO account. Now, if you transfer from your NRO account to your own saving account, so it is clearly a violation, because you yourself are declaring in one account that you are a non-resident, while in other you are saying that you are resident India, which is not allowed as per FEMA. So you have to be careful about such small mistakes that you do, which can have large compliance problems. Third is investing or purchasing property in the name of spouse, relatives by applying your own funds. So if you are trying to invest, if you are trying to send money into India to your parents, and then they are buying property in their own name, there can be clubbing provisions as per income tax, and there can be other serious consequences as per the Prevention of Money Laundering Act as well. Engaging in any prohibited activities like buying farmland. So an NRI is not allowed to buy a farmland, a farmhouse, or he is not allowed to engage in a real estate business of trading flats and all. So all those activities are prohibited for NRIs. But if he directly is funding that through his relatives and all, so even those activities are not allowed. So you have to be careful. Now, what are the investment options available for NRIs? Uh, for a good investment, basically there are 5 parameters to gauge whether the investment is good or not. First is liquidity, how liquid the asset is, how easily can you move the money or liquidate the money. Second is, are the returns satisfactory to beat inflation? Third is the risk tolerable, or you're taking a lot of risk exposure just to gain that return. Fourth is, how much is the net tax return? So if there is any tax liability, then how much is it, and what are the net tax returns? And finally, peace of mind, how easy it is to invest and to withdraw. Now, India serves as a very good destination to provide you good investment opportunities based on all these 5 parameters. There can be different options and strategies which you can adopt. One is obviously your goal-based financial planning, where you can specify your targets like children education, retirement planning, child marriage, uh, or pension or whatever. You can have your goals defined, and then based on that you can do a reverse calculation that are there any particular investment opportunities available in India. And obviously yes, there are. Second is mutual fund. If you just want to keep building a pot of pension plan, then you can keep investing into mutual funds in India. There are tax-free investment avenues available as well. PMS is another thing, where you can invest in equity directly. Sorry, indirectly, where a fund manager will be there to take care of all your investments. There will be an active trading in your name, in your PAN, but some fund manager will manage all those investments on behalf of you. Next is insurance products like life insurance, health insurance, and other products. And the last one is property. You can, if you are having any capital gains from India, then you can reinvest in another property to save taxes and all. So there are various options available to invest in India. Now, investment in real estate for NRIs is something we get a lot of queries about. Like the tax structure is such that you can avail loan at a very discounted rate. The interest becomes deduction from your income. Then even principal repayment qualifies for ATC reduction. So there's a lot of buzz around taking house property in India. So what we say is that you have to check with other parameters as well, like the regulatory compliance. Like it cannot be a agricultural land or a farmhouse or a property which is agricultural basically. So NA property is mandatory, which is non-agricultural. Next is the kind of documentation and due diligence that you need to go through to buy any property. Then the funding restrictions regarding source of funds for property transactions in India. Like if you are um, bringing money from outside India, then what is the source of that money? Even that needs to be checked. And then taxation on rental income and capital gains. The TDS rate is too high. If you are looking to rent it out, then 30% plus a surcharge of 4% is something which the tenant will pay on your behalf. So you'll be getting only 70% of the rent. So there's a dent to your cash flow that also you need to consider. And then the property management and tenant issues, which are very high in India. And unfortunately, we don't have a lot of professional organizations who can manage on your behalf. Now, these are certain returns provided by the equity mutual funds for the past 1 year. As you can see, everybody has given more than 30% returns in the last 1 year. This is exactly from February to February 24. And as you can see, these are the top mutual fund categories which have given you returns of more than 30%. Now, considering the last 5 years horizon, again, the returns have been phenomenal in mutual funds. Obviously, small cap fund has been the leader in getting returns and all. But then there are, if you want to diversify your risk, if you want to keep it, low risk kind of a portfolio, then there are other categories of mutual funds available which can reduce your risk exposure, but at the same time, as you can see, the returns have been very good as compared to many other markets. Regarding the capital gains on mutual funds, how it is taxed in India is the debt funds are taxed on your slab rate. Slab rate is like basically it's added to your income, and then whatever is the slab rate applicable to you, like first 2.5 lakhs is exempt, and then the slab rate increases. So accordingly, it will be taxed. Now, equity-based mutual funds, basically these are the funds which invest more than 65% in equity. For them, the taxation is if it's a short-term capital gain, like if it's sold 12 within 12 months, then the taxation is 5%, and if it is sold after 12 months, then you get flat rate of 10% tax. And even on that, first 1 lakh of your tax is exempt. Again, the same is for hybrid equity oriented funds and hybrid debt oriented funds. So they have similar taxation like equity and debt funds. Now there are certain interesting avenues in DTA as well. Like for example, I've taken this from UAE. There is if you are a NRI from UAE, then there is a special you can say exemption for capital gains on mutual fund. So what happens is a DTAA is basically it specifies which income will be taxed by which country. So in the India UAE DTAA, it specifically says as per Article 13(5) that any capital gains arising from assets other than those defined in Article 13(1), 2, 3, 4 will be taxed in the country of residence. So basically, if you're a UAE NRI, then it will be taxed in your country, which is UAE. And since there is no personal tax there, some of the assets are exempt from taxation in UAE. Some of them are like mutual funds, corporate bonds, or government securities. So these are not taxable in India, and by virtue of that, it becomes tax free in UAE as well. Thank you. I'm open for any questions now. We can take it.